Okay, good afternoon, everyone. Today is the 26th of June, 2021, and today we'll be discussing on borrowing costs with respect to IAS 23. And from this perspective, we'll be looking at instances where an entity may have incurred borrowing costs, which could be made up of interest from bank overdraft, interest from short-term and long-term loans, finance charges that might have accrued from lease receivables or leases in that case, or exchange difference that might have related to a borrowing that will have impacted the measurement of interest costs, as the case may be, in line with the requirement of IAS 21. When such an entity has incurred borrowing costs, and the borrowing cost relates to assets that is self-constructed or self-developed and takes substantial period of time to complete and put to use, how do we treat such borrowing costs away from other borrowing costs that are recognized in the profit or loss or in accordance with any other standard? Now, IAS 23 is a standard that tends to more or less reshape the way and manner in which we treat borrowing related costs in the financial statement as a means to reflect in the true position of those assets that are instrumental to such borrowing, in which those costs have been incurred in favor. Now, but in order to enhance our understanding about this, we'll look at two critical definitions that were only given by IAS 23 as a standard. And those two key definitions are borrowing costs itself and qualifying assets. Now, the standard makes us understand that borrowing costs are interest costs and any other related cost that has been solely incurred by an entity in connection to the borrowing of funds with respect to qualifying assets. And that is what makes us to extend further the definition to say, what then do we consider as qualifying assets? IAS 23 makes us know that a qualifying asset will be an asset that takes substantial period of time necessarily in order to get it ready for its intended use. And what the standard makes us understand is that certain conditions are prevalent, of which two of them are attributed to this definition in order to recognize the capitalization of borrowing costs along with those qualifying assets. And I will once display the definition once again for us to have better appreciation on it. And thereafter, we'll try to look at the scope requirements of the standard with respect to what are the exceptions to the rule in which borrowing costs may not be capitalized for certain assets, which might be deemed not to be qualifying assets. Now, in summary, again, borrowing costs explicitly in the standard is defined as the interest and other costs incurred by an entity in connection with the borrowing of funds. And the borrowing cost to which it's required to be capitalized will be that attributable to qualifying assets. And that is what makes the standard further define qualifying asset as an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. But we need to take note of certain things, that the standard does not define what substantial period of time is, but guidance and practice as more or less giving us view of what substantial period is. A substantial period in principle and practice is a period that is not less than 12 months accounting year, which means any period to which you are borrowed funds and to which the asset you are borrowed on will take minimum of 1 year to construct, to get ready for use, or to get ready for level to which it can be sold. Such assets may have qualified for capitalization of borrowing costs, as the case may be. And that's why the standard also went further to tell us that borrowing cost is not limited to the interest cost, but borrowing cost is interest cost, which can be on bank overdraft, which can be on short-term borrowings or loans from banks, which can be long-term borrowings or loans from banks. Secondly, it could also be in a period where you have lease arrangements. Your borrowing costs may be attributed to finance charges that arose from the lease arrangement in line with the requirement of IFRS 16, which we have discussed extensively. You can go to the video and you can see that also. And finally, it also speaks to exchange differences arising from foreign currency borrowing to the extent that they are regarded as an adjustment to interest costs in line with the requirements of IAS 21. Therefore, these are what will shape our narrative to appreciating and having a better understanding of borrowing costs. But there are two categories of exception to the scope of borrowing costs in line with the requirement of IAS 23. Now, IAS 23 requires that an entity more or less recognize borrowing costs and will capitalize such on the premise that it relates to an asset that is acquired, self-constructed, or produced that takes substantial period of time. But there are exceptions to that rule. Some of those exceptions is that an entity is not necessarily required to apply the requirement of IAS 23 to borrowing costs directly attributable to acquisition, construction, or production of one, a qualifying asset that is measured at fair value. Such are biological assets, which when we get to IAS 41 under agriculture, we'll have a better appreciation of it. And to investment property, in which we've discussed in one of our sessions, that will have been measured at fair value to profit or loss. Such assets, even though they might qualify as an asset relating to borrowing costs, but because of the rule or the principle that they have been measured at fair value, and of which the impact of fair value measurement goes to profit or loss, such borrowing costs will immediately be reported in profit or loss. Secondly, the requirement of IAS 23 may not apply to inventories that are manufactured or otherwise produced in large quantity on a repetitive basis. What does that mean? If inventory is produced by way of manufacturing or production on a repetitive basis, example, product line like, let me say, Coca-Cola, cement from Dangote Cement, and all of what is repetitive in nature of production, and it does not necessarily take an extended period of production, such will not qualify for the purpose of this standard. But there are some that constitute inventory that will qualify. Example of such inventory is ship. When you build ship to sell, or you build aeroplane to sell, okay? Or you build specialized cars. When I say specialized cars, I'm not talking of random cars or common cars that takes cycle of 1 week, 2 weeks, 1 month. We are talking of specialized, customized cards that could take about 1 year plus to build, which are not repetitive in nature. Probably you are talking of all these Rolls-Royce Phantom, depending on the level to which it's customized. But those ones that are easily feasible are inventory, such as aircraft that is produced by Boeing or Airbus, ships, and etc., that takes substantial period of time. They will necessarily qualify for borrowing cost requirements under IAS 23. But for other ones that are of repetitive nature, may not qualify. And remember, IFRS is principle-based. It then means that it is the overall substance of the transaction that will form the basis of the judgment that will be adopted in order to identify those that expressly qualify away from those that may not have qualified. And on that basis, we are going to look at certain things with respect to examples of such assets that may qualify and those ones that seem to qualify, but they don't necessarily qualify because of the conditions required are not fully met. But before then, if there's any question, I'll be willing to answer such a question. Any question before we go down to the examples and to further technical discussions?
Okay, so my question is thus. So basically, borrowing cost, as it relates to IAS 23, has to do with the finance costs that we should capitalize vis-a-vis those that do not come under IAS 23. They are the ones that will be expensed in the period that they were incurred. I think if I get you right.
Yeah, we are coming to the effect of applying IAS 23.
Okay.
When we get to the effect of applying, why are you applying IAS 23? It's because there's an exception to a general rule that normally interest cost, borrowing cost, finance cost, or related costs should have been expensed as a period cost. But in this case, some will go by way of product cost, some will go by way of capital cost. And that's what we are trying to establish. Okay. Does that make sense?
Yes, sir.
I would just like you to throw more light on this exemption from IAS 23. You know, you talked about investment property measured at fair value, that borrowing cost associated with it is not recognized under IAS 23. I would just like to know more.
Okay, now what we are trying to say is this. Before you apply any standard, you must understand that there's no standard that is exhaustive, like it addresses every situation. No. Each standard addresses a defined and peculiar situation. Now, what IAS 23 tends to address is the exception to the general rule of expensing borrowing costs. And this standard now says that any assets that takes substantial period of time to construct, to acquire, to build, to produce, and of which you have borrowed to finance it, the associated cost of borrowing, such as interest costs, transaction costs, if there's any exchange rate differences arising from it, because it's a foreign borrowing, and other incidental costs, such should naturally be expensed as finance charge. But instead of expensing it as finance charge, what IAS 23 tends to actualize is that no, you capitalize it along with the cost of that asset. Now, if you now look at that, when you pick biological assets, when you pick investment property that are measured at fair value, you find out that they qualify by that definition. But because if you go back to the scope of IAS 40, and likewise, if you go back to the scope of IAS 41, you find out that those standards are taking care of how such related costs should have been treated. And therefore, they are now scoped out of IAS 23 in order to avoid conflict of treatment.
Okay, I have one more question. I don't know how, I just wanted to throw more light on it. For instance, in a situation whereby you see that a company share is rising very high, like at a very drastic rate, and you go ahead to borrow from a bank in order to acquire that shares, you know, borrowing costs associated with that loan, with that bank loan, can it also be capitalized?
Okay, that is where we're going to now.
Okay.
You now ask yourself first, does financial assets to which you are borrowed to finance, does it qualify as an asset that falls under IAS 23 borrowing cost? It's until we answer that question. By the time we answer that question that it qualifies, probably you can move to the next level that, okay, what happens? But if it doesn't qualify, it then means that treatment that is accorded it in IFRS 9 will be the strict treatment you follow. Okay, I'll give you a chance to now read this up for us. What constitutes a substantial period? And let us look at examples of qualifying assets and those that are not necessarily qualifying assets.
Okay, what constitutes a substantial period of time? IAS 23 does not provide any guidance on what constitutes a substantial period of time. The specific facts and circumstances should be considered in each case. For example, it is likely that a period of 12 months or more might be considered substantial. Depending on the circumstances, any of the following may be qualifying assets: inventories, manufacturing plants, power generating facilities, intangible assets, investment properties, and bearer plans. The following are not qualifying assets: assets that are ready for their intended use or sale when acquired, financial assets, and inventories that are measured or otherwise produced over a short period of time.
That makes sense now.
Yes, sir.
Therefore, your question about you seeing a particular share price of the company falling and you want to take advantage, you now want to borrow to finance it, the borrowing cost of it, can you treat it in line with borrowing cost for financial asset? The answer is what now? What's the answer, sir?
The answer is no.
Yeah. And if it's no, you now revert to IFRS 9. And IFRS 9 has told you that you can't offset financial liability with financial assets. There are only strict conditions that need to be met. And the two conditions are: one, is there legally enforceable rights? And two, by the practice, agreement, or otherwise, is the asset going to be realized first solely for the purpose of settling that obligation? It's upon meeting those conditions that you can offset. Which then means that at the end of the day, you find out that the answer has been given, that what you intended doing cannot be done. Does that make sense, sir? Now, let me let you guys understand something, that don't jump to applying a standard when it may not be relevant. That is why at every point in time, when we start, we try to define the objective and the scope of a standard so that you don't even go there if it's not something that falls within it. You can say now. And that's why no matter how good a physician is, a physician must always get a report of a test to even know whether it is this side I need to go or this particular side. No matter your experience, you can't just jump without having some level of result from a test that will give you some leeway to see actually where you're supposed to fall to. Does that make sense, sir? Now, let's probe further the issue that borders on assets with an extended delivery period or extended period that it will take it to be constructed or produced in order to be available for its intended use. Okay, let's look at this.
Okay. Assets with an extended delivery period. IAS 16 identifies delivery and handling costs as part of the cost of an item of property, plant, and equipment. It includes such activities as parts of the process of preparing the asset for its intended use. The shipping of an asset is therefore part of its acquisition, and consequently, borrowing cost attributable to the shipping period can be considered to be borrowing cost directly attributable to the acquisition of the asset as required by IAS 23. For example, an entity orders and pays for a large piece of equipment from overseas that will take 6 months. In this example, that will take 6 months to arrive. In this example, judged to be a substantial period of time for the purpose of IAS 23. A loan is raised to finance the acquisition. The equipment is already manufactured and available for shipment. Therefore, the period between payments for the equipment and its installation is only caused by shipping time. The asset is recognized by the entity on the date of shipping by the supplier because in this example, that is the date on which control passes to the entity. Borrowing costs incurred on the loan raised to finance the acquisition will be capitalized as part of the cost of the equipment if as part of the cost of the equipment up to the date that the asset arrives at its destination, is installed, and is ready for its intended use.
Thank you very much. Now, since we have established what may have qualified under the requirement of IAS 23, let us now ask ourselves, since they've qualified, what is the next order? That means the next order would be, how do we then treat such a borrowing cost on a qualifying asset? Now, what we are made to know, which I've also given clear before now, is that borrowing costs on a qualifying asset should be capitalized from the commencement of that construction of that asset or production of that asset, provided the borrowing has taken place at that point, up to the period where the asset is completed in principle, and what my word, in principle, so that it's available for its intended use. And I'll break it down one by one with scenarios. One, let us say it's an asset that if you don't complete it as a whole, you can't make use of it. Therefore, what it means is that if the construction started 1st of January 2019, and you borrow immediately to finance it from that 1st of January 2019, you will capitalize it up to, let us say, by December 2020, the asset has been completed so that it's available for intended use. Whether you now use it or not doesn't matter. But is it available so that the stage it is, it can be used for the purpose to which it was constructed? If the answer is yes, it is at that point you will stop capitalizing. Do you get what I'm saying now? Because it's at that point you have been able to ascertain the acquisition cost, which includes the cost of construction, purchase, and also of the and incidental cost, of which borrowing cost is an incidental cost. Now, which means capitalization runs from commencement of the construction of the assets or production or manufacturing of the asset, or to the point it is available for intended use, regardless of whether it is used. Now, the second scenario is this. The asset may not have been completed, but by nature, the stage it is, it can start to be put to use. Do you guys see now? For example, you want to build 10-story building, and you have gotten to the 10th floor, of which we have even done the roofing, elevator, everything has been done. The only thing that's happened is that probably the 10th floor is a penthouse that you have a particular design you want to do for interior. But all other floors from ground zero to 9th floor has been completed. It is now ready for whatever purpose it is for. What happened in that is that substantial part of everything has been completed. Probably what is left is just a testing for the 10th floor or penthouse. In that case, the same thing applies. The borrowing cost will cease from that period. The third scenario I'll break down is this. It's possible that the 10th floor is also a critical part that is material. And if that is the case, you will find a way of separating activities of other floors from the 10th floor. And likewise, the borrowing cost will be attributed to those other floors and separately from the 10th floor. The one attributable to other floors will cease to be capitalized from when they are already available for intended use, while the one for the 10th floor will still continue to be capitalized until it is substantially completed for its intended use. And that scenario is premised on the fact that the 10th floor is equally a material component of the entire building, not something that is immaterial in all respects. That is that. Does that make sense? Now, if it do make sense, let me take you up through this process and we'll come back to explain further other scenarios. Over to you guys.
Okay, let me read it. IAS 23 capitalization. I can't see. Okay. All eligible borrowing costs must be capitalized. Only borrowing costs that are directly attributable to the acquisition, construction, or production of a qualified asset can be capitalized as part of the cost of that asset. The standard lays out the criteria for determining which borrowing costs are eligible for capitalization. Borrowing costs eligible for capitalization. Those borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset must be identified. These are the borrowing costs that would have been avoided had the expenditure on the qualifying asset not been made. This is obviously straightforward where funds have been borrowed for the financing of one particular asset. Difficulties arise, however, where the entity uses a range of debt instruments to finance a wide range of assets so that there is no direct relationship between particular borrowings and a specific asset. For example, all borrowing may be made centrally and then lent to different parts of the group or entity. Judgment is therefore required, particularly when further complication can arise, e.g. foreign currency loans. Once the relevant borrowing are identified, which relates to a specific asset, then the amount of borrowing costs available for capitalization will be the actual borrowing cost incurred on those borrowings during the period, less any investment income on the temporary investment of those borrowings. It would not be unusual for some or all of the funds to be invested before they are actually used on the qualifying asset. IAS 23, paragraphs 10 to 15.
Okay, thank you very much. Now, let me also take it further. Now, first, the scenarios are portrayed first of all considered a single asset, and you borrow specifically for that asset. What if you borrow a single fund, and that fund is used to develop different assets? How do you determine the borrowing cost attributed to that? If you borrow, let me say you borrow 10 million naira, but you have 3 separate assets you are financing with it. The question is, what is the borrowing cost? You can use the proportion of what portion of that 10 million was used to construct an asset to more or less apportion the borrowing cost. That is one scenario. Another scenario is when the borrowing is such that a company has a policy whereby different aspects of its business requires funds. And from its treasury function, it does what we call a group or a single borrowing to take care of its funding needs. And in that situation, what happens? You are financing for working capital, you are financing for construction of an asset, you are financing for investment in other companies and some other different things. Now, in doing that, you have different sources of borrowing. You did commercial paper, you did debenture, and at some point in time, you have bank loans. Now, they come at different rates and all sorts of things. And these borrowings are not done specifically for a particular project. It was just done from the more or less like the corporate finance activity of the company that have identified the funding gap for all of its functional projects, including asset construction. In that scenario, what the standard says is that since the specific borrowing was not made and there is no basis to reasonably identify which source of funding is for that particular qualifying asset, you resort to using the capitalization rate. What is capitalization rate? It is the use of the use of the weighted average borrowing rate of the company. And you use that rate to determine your borrowing cost. And we're going to see that as we move on. But there's a clause to that. Because you are using weighted average, there's a possibility that by the time you do that, it might give you borrowing costs that will have been more than the total borrowing cost, actual borrowing cost. And in that case, the standard says you now have to restrict what you have gotten as a result of the capitalization rate to what will have been the actual borrowing cost, so that you don't overestimate what the borrowing portion, a borrowing cost allocated to that project will have been. And probably we'll see it in the course of our discussion. Okay, that's what we need to take note. But the last aspect of the scenario is what brought about a question that I've raised. And what is the question? The question says that what treatment are we going to give to interest or investment income that is attributable to the unutilized funds in the period of substantial time of construction? And what does that mean? Imagine you borrow 10 million naira on 1st of January 2019 for that asset we are talking about in the other time. And the asset will take 2 years to complete, which will have been completed at 1st of December 2020. Now you borrow 10 million naira. 10 million naira has been drawn into your account. You have it in your account. But you will not carry the 10 million naira and give it to your contractor and say, go, I'll be waiting after 2 years. Let me see everything ready. No. Based on bill of quantity, based on what has been agreed, based on the project phase, you release funds intermittently, which then means that if you have released 40% of the fund, the 60% of the fund is in your account. One of those corporate finance strategies is that you can't keep idle fund because there's a cost to it, at least cost of borrowing. And what do? You try to reinvest that fund, pending when the next phase will come, in which you now release further funds. And the question then is the income arising from the interest or investment from such reinvested fund. How do you treat it? And the standard says we are going to treat it as a reduction of your actual borrowing cost. What it means is that if your borrowing cost is 1 million, before you capitalize it, your interest income that you realize is 400,000. You now net the 400,000 against the 1 million to arrive at 600,000, which will now be capitalized, which means the borrowing cost you capitalized will be net of associated interest or investment income for the unutilized fund. And that is what it means. Which then means that in that case, the interest income on reinvested, unutilized will be used to reduce the borrowing costs prior to or before capitalization. On that premise, we'll look at this question. Okay. I'll give you guys 5 minutes to lay your hands on this before we jointly profile solutions to it. Do you get what I'm saying now? Okay.
Okay.
Okay, now let's look at this practice question. On 1st of January 2016, Streeman Co. borrowed 1.5 million to finance the production of 2 assets, both of which were expected to take a year to build. Work started during 2016. The loan facility was drawn down and incurred on 1st January 2016 and was utilized as follows, with the remaining funds reinvested temporarily. Now, on 1st of January, they withdrew 250,000, which was spent for part construction for asset A and 500,000 for asset B. On 1st of July, which was 6 months after, they withdrew 250 to fund construction, the remaining construction of 250, and that's for asset A and 500 for asset B. Now, the loan was obtained at a rate of 9%, and the company was able to temporarily reinvest the surplus fund, which was the undrawn portion between January and July, for 7%. Required, ignore compounding interest, calculate the borrowing cost which may be capitalized for each of the assets, and consequently, the cost of each asset as at 31st December 2016. Now let's look at our model. Now I've extracted the information out, and let me start with step 1, borrowing cost. Now, when you see the old amount borrowed is 1.5, when you check all what was incurred, you find out that the sum incurred was 500,000 for A and 1 million for B. And I suspect that the entire 1.5 million borrow was spent on these two assets solely. Okay. I remember, even if they borrow 1.5 million, but they spent only 1.2 for this asset, it is only borrowing cost incidental to 1.2 that will be capitalized, not the entire 1.5. The portion relating to 300,000 will be expense because it has nothing to do with the asset. Let us take note. Now, the question is this. The loan of 1.5 was borrowed for a whole year, which means the borrowing cost, or let me say the interest cost now, for 12 months is as follows. For A, it is 9% of the total amount borrowed with respect to construction of asset A is 500,000. And because it's 12 months, it is 12 over 12. Otherwise, and I'm emphasizing this 12 over 12 because in another question, it might be for 18 months where you have already done 12 months last year and you are doing the balance of 6 months this year. Take note of it because the interest rate is per annum and therefore you must consider the effect of time. For B, it's the same 9%, but in this case, it's 1 million. And the same time. Therefore, what will happen is for us to find the product of this 9% and the 500,000. And that gives us 45,000. And for B, it is the same 9% multiplied by the 1 million. And that gives us 90,000. Invariably, this is my borrowing cost prior to netting it off against the interest income arising from reinvestment. Now, step 2. Let us determine the interest income or reinvestment income on unutilized fund. And remember, it is temporary because later it was utilized. You only earn interest during the period it was not utilized that was reinvested. And that period we also recognize. The period to which it was reinvested ranges between 1st of January 2016 and 38th of June 2016, which means it's 6 months we invested because as at 1st of July, we have withdrawn those money as at 1st of July to pay the contractor. Okay, and in that case, what happens? I can put the interest for A, which is 7% times the 250, the 250, which is after, okay, let me do it like this so that we'll come back to that. Let's determine how much was reinvested. Step 2. How much was reinvested? How much was reinvested is the difference between, that is for A and B. is the difference between the amount borrowed for each asset. How much was borrowed for each asset? 500 and 1 million. Less amount utilized on 1st of January 2016. The amount utilized, which we gave the contractor, was this amount as at this date for asset A, and this amount for asset B. Now, invariably, what do we have? Which means this is the amount we invested. And that's how I got my 250. And for B, was 500. And this is for 6 months, because it was only temporarily invested for 6 months before 1st of July, because as at 1st of July, the contractor is coming to collect the money. And therefore, that is product of 7% multiplied by this amount multiplied by 6 months. 6 months is 6 over 12. We'll do the same thing for asset B. 7% multiplied by 500 multiplied by half a year, 6 over 12. That is it. Therefore, this represents our interest cost. I sum it up, which is my step 3. Now, step 4 is to determine my borrowing costs, which is net of the interest income for capitalization. The amount I'm going to capitalize invariably will be my borrowing cost less my invested interest income. And what is the investment, the borrowing cost, which is step 1. Step 1. And investment income, which is step 3. And that's it. Okay, invariably, Now, remember, this 250 is coming from step 2. Let me emphasize it. And that is that. At the end of the day, we have this. Now, the final question says, step 5. What would be the acquisition cost or capitalization cost of the assets as at when the asset was completed? It was completed on 31st December 2016. It is a cost, construction cost, plus borrowing costs or net borrowing costs, as the case may be. Now, what is it? Construction cost, remember, 500 for A and 1 million for B. While the net borrowing cost is from step 4, which is this and this. Let me refer step 4. And that is that. Does that represent what you guys have in mind or what you guys did? I want to hear you out.
Yes, this is exactly what we had in mind, but I think you have better presented it.
Okay. Now, I'll now play a game with this. I'll play a game with this. I'll tweak the question and see what the output will be. I'll change the question. They borrow 1.5, but I want to change it that this was 300, while this was 200. This is, let me say 450. This is 550. You can say now. Now, everything will change automatically because it is modeled. The only thing that will not change is this one I type for reference purposes, which means this is still the same. This is no longer 250, it is 300. This is 450. You can say now, okay? And every other information applies in this manner. Okay, this 450. Yeah. Now you can see how the results differ slightly. Can you see the difference?
Yes.
Okay, now let me do another variant. The other variant is that it's still the first initial one, but the old money is not 1.5 you borrowed. It is 1.8 you borrowed. But borrowing 1.8 will have no influence on this because it is what you utilize on those assets that matters. The question then is technical note. So you borrowed 1.8 million. But utilized only 1.5 million for the assets. Asset A and asset B. Now, what has happened? This implies that the difference of $300,000 may have been used for working capital and operations, of which associated interest cost should be expensed or charged as a finance cost to profit or loss in the period. Does that make sense to you?
Yes, sir.
Does that make sense? Therefore, this one single illustration, I've used it to demonstrate difference, which means what I've done here is to say, I'll come here, let me just pick up white stuff. Let me change this. This is now 1.5. This is 1.8. 1.8 million. Okay? It's 1.8 million, but what was invested was 1.5 to this asset. That's why this conclusion was made. Now, this one too, it is 1.5, but what was different? What was there was 300, 200, 450, and 550. Does it make sense now?
Yeah.
Means you have enough illustration to repeat the understanding. Now, that will now take us to having better appreciation to understand the aspect of general borrowing. When you have general borrowing and you have to resort to capitalization, what happens in that situation? But before then, any other question?
No question.
Okay. Okay, let's move on now. And one thing I make you guys understand is that I'm not a fan of formula. I'm a fan of the principle and the narrative, even though we are going to make use of, you'll see how simple those formula is, rather than you cramming formula. Okay? Can somebody try to take us through how we calculate the capitalization rates, and we'll use practical illustration to depict that understanding. Over to you.
Calculation of capitalization rate. When a qualifying asset is funded from a pool of general borrowing, IAS 23 Section 14 requires that the amount of the borrowing cost to be capitalized should be determined by applying an appropriate capitalization rate to the expenditure on the qualifying asset. The capitalization rate is calculated as follows. Total general borrowing cost for the period, i.e., excluding specific borrowings, divided by weighted average total general borrowing, i.e., excluding specific borrowing. In a situation where borrowing are obtained generally, but are applied in part to obtaining a qualifying asset, then the amount of borrowing costs eligible for capitalization is found by applying the capitalization rate to the expenditure on the asset. The capitalization rate is the weighted average of the borrowing costs applicable to the entities borrowing that are outstanding during the period, excluding borrowing made specifically to obtain a qualifying asset. However, there is a cap on the amount of borrowing costs calculated in this way. It must not exceed actual borrowing costs incurred. Sometimes one overall weighted average can be calculated for a group or entity, but in some situations, it may be more appropriate to use a weighted average for borrowing costs for individual parts of the group or entity.
Okay, now on that premise, I want you guys to attempt this question. Read it out and let's discuss it in a few minutes.
Acronico are the following costs. Can't see this thing well. Okay. Acronico had the following loan in place at the beginning and end of 2018. So we have 1st of January 20x6 and 31st December 20x6. Okay. 10% bank loan repayable 20x8. 1st January, you have 120 million, 31st December, still 120 million. 9.5% bank loan repayable 20x9. 1st January was 20x6, we have 80 million, and 31st December, we have still 80 million. On 1st January 20x6, Acronico began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawn down for the construction was 30 million on 1st January 20x6, 20 million on 1st October 20x6. Required. Calculate the borrowing cost that can be capitalized for the hydroelectric plant machine.
Okay, who will try to explain it so that we'll not do it together? We just need guidance. Who will guide us through? Okay, let's go back to our model.
Okay, let me just say, okay, where is it? Just say this. I don't know if, okay, since they already had, okay, I can't see the,
Can you see it now?
okay, yes, I can see it. So since they already had this loan as that, this loan was in place as a 20x6. Now, the amount expended on the plant out of the total pool, the interest on it will be, out of the total interest that we pay, the interest paid for the amount used for the construction definitely will be capitalized on that construction. For instance, 10% for the one for the 30 million and 20 million. Oh my word, I'm getting something, I'm mixing something up. But I think that is just the portion of the loan, the interest on it that will be capitalized depending on the loan that was used, but which is not shown here.
What is not showing then?
Now I'm looking at, they said drawn from the construction was 30 million on 1st January and 20 million on 1st October. So I was just saying that depend on the category of loan that the money was drawn from.
We have said that this is a general borrowing. They borrow randomly and they utilize the fund randomly. Therefore, that's why we are to resort to using capitalization rate, since we cannot trace it specifically. Are you getting it now?
Okay.
The loan drawn on construction as at 1st of January was 20 million. Okay. This 1st of January 2016, and the one for 31st of October 2016. Okay, how much was drawn? 30 million in one. Second one was 20 million. Okay, the total loan balance is 120 million, 80 million, the same amount. Now, the interpretation of this is that the loan is not a loan you pay principal and interest. The loan is synonymous to like bond, where you only pay interest on a yearly basis and you pay principal at maturity of the loan. Take note of that, please. Now, that is what I've tried to restructure here. Okay. What other information? No information. Now, let me just put the interest rate here so that I can be able to map it. The interest rate is 10%, and this is 9.5%. Okay. Now, what do we need to do? We need to determine the capitalization rate. What is our capitalization rate? I told you don't need formula. You'll find it more logical unreasonable to determine it. Now, step one. Step one. Calculate the capitalization How do we calculate the capitalization rate? You are going to look at it and say, okay, don't type. These are the loan type. Okay. Amount. Interest rate. And factor, or you call it ratio. Now, what is the interest rate? 10% and 9.5%. Okay, what is the factor? The total loan that constitutes our general borrowing is this, 200 million. Now, what is the ratio? What is the ratio? The ratio of 120 to 200 is, let me put it in percentage. So to see the 2%, that's 60%. And this is 40%, which sum up to 100%. Now, you now simply ask yourself, okay, this percentage multiplied by this, what does it give you? Which means my capitalization rate is equal to this 10% multiplied by this 60% will give me the weighted average for the first loan type. And for the second loan type, this 9.5% multiplied by 40% will give me for the second type of the loan. And once I do that, what is the weighted average? The weighted average rate is the product of this, which is 10% plus multiplied by 60%. And I can just drag it down. And what does that give me? That gives me 9.8%. And that is it, which means this rate is what I have here, 9.8%. Very straightforward. Now, that is how we determine capitalization rate. Step 2 then is, what is the borrowing cost per, okay, what's the borrowing cost? Now, the borrowing cost, I'll look at the drawings. The first drawing, drawn on 1st of January 2016, and second drawing, drawn on 1st of October 2016. How much was drawn? Amount drawn. Amount drawn, 30 and 20. That sum up to 50. Now, the next thing is to apply the rates. Weighted average rates. I'll call it WAR. It's the same rate. And therefore, what is the borrowing cost? But before then, let me put the period there. Period to which I can put interest. January to December. Reporting date is December. Okay. Reporting date is December. January to December is 12 months. Why October, 1st of October to December is 3 months. Therefore, I remember the whole year is 12 months. Therefore, what is my interest? Borrowing cost now is this percent multiplied by the amount multiplied by the period. Actual period over 12-month calendar period. What's wrong? Okay, let me delete it. Product as a function of the rate, function of the amount, function of the time. And I'll do for and that should give me the amounts. Does it make sense?
It does.
That is it. Which means, can you see that it's more better than putting the formula? You don't need formula. It's just to follow it sequentially and you model it out. And that's just all. Okay. Now, let me give you a clue. Okay. What if I'm trying to modify the question? Let me try and modify the question. What if I modify the question and I say that, note, there was a specific borrowing that partly finances the construction at the beginning in the sum of, is in dollars, 10, in the sum of, let me say $12 million at an interest rate of 12%. Now, what I'm trying to say is that the project naturally was financed at the beginning with one loan, but the maximum you can get was 12 million and probably financed at 13%. But because you can't get specific loan again, you now have to resort to part of the general borrowing. Now, what this means in principle is that that portion of specific must first be addressed, which means this rate we only apply, which means I will extend this downwards so that I'll first of all say the specific borrowing will be different from general borrowing. These are general borrowing. Therefore, what will happen? The specific borrowing was 10 million. Let me bring it here. Specific borrowing. 1st of January 2016, 10 million. What it then means is that 12 million, sorry. It means probably the total project cost will now be 62 million, which means we initially borrowed 12 million, but to make up for the balance, that's when we resort to the general borrowing pool. Therefore, in that case, what will happen? The specific borrowing, we address that separately at 12 million. And that one has a rate. I'll say this is weighted and specific rate. Specific rate applies to this, which is at what percentage? Interest at 13%. Therefore, we apply that 13%, 12 months. And invariably, the portion that is specific, you will never apply general rate to it or weighted average rate to it. And that is it. That's another variant of the question. Does it make sense?
Yes, it does.
Okay, that is that. Now, Let me copy this and take it to okay. Okay, I've copied the solution there. Now let's look at other critical areas. Okay, over to you, Shegun, as we wrap up the discussion.
Okay. Carrying amount exceeds recoverable amount. A situation may arise whereby the carrying amount or expected ultimate cost of the qualifying asset exceeds its recoverable amount or net realizable value. In these cases, the carrying amount must be written down or written off as required by other IFRS standards. In certain circumstances, again, as allowed by other IFRS standards, these amounts may be written back in future periods. Commencement of capitalization. 3 events must be taking place for capitalization of borrowing costs to be started. A, expenditure on the asset is being incurred. B, borrowing costs are being incurred. C, activities are in progress that are necessary to prepare the asset for its intended use or sale. Expenditure must result in the payment of cash, transfer of other assets, or assumption of interest-bearing liabilities. Deductions from expenditure will be made for any progress payments or grants received in connection with the asset. IAS 23 allows the average carrying amount of the asset during a period, including borrowing costs previously capitalized, to be used as a reasonable approximation of the expenditure to which the capitalization rate is applied in the period. Presumably, more exact calculations can be used. Activities necessary to prepare the asset for its intended sale or use extend further than physical construction work. They encompass technical and administrative work prior to construction, e.g. obtaining permits. They do not include holding an asset when no production or development that changes the asset's condition is taking place, e.g. where land is held without any associated development activity. Suspension of capitalization. If active development is interrupted for an extended period, capitalization of borrowing costs should be suspended for those periods. Suspension of capitalization of borrowing costs is not necessary for temporary delays or for periods when substantial technical or administrative work is taking place. Cessation of capitalization. Once substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete, then capitalization of borrowing costs should cease. This will normally be when physical construction of the asset is completed, although minor modifications may still be outstanding. The asset may be completed the asset may be completed in parts or stages where each part can be used while construction is still taking place on the other parts. Capitalization of borrowing costs should cease for each part as it is completed. The example given by the standard is a business park consisting of several buildings.
Okay. Now that speaks to virtually all what I've said earlier on, and that represents the position of the standard with respect to that. Okay, now there are some other things I want you to look into. And one of them is, how do you recognize impairment loss or write down on such an asset that has an element of, what's it called, borrowing costs embedded in it? And what is the disclosure requirement? Can you take up this?
Recognition of an impairment loss or write down. When the carrying amount or the expected ultimate cost of the qualifying asset exceeds its recoverable amount or net realizable value, the carrying amount is written down or written off in accordance with the requirements of the IFRS standards. In certain circumstances, the amount of the write down or write off is written back in accordance with those other standards. Carrying amount of asset exceeds the recoverable amount. Therefore, once borrowing costs have been identified as appropriate for capitalization, they should be capitalized as part of the cost of the qualifying asset. This is so even when the expected ultimate cost of the qualifying asset exceeds its recoverable amount or net realizable value for inventories. In such cases, the appropriate treatment is to capitalize the borrowing cost as part of the gross carrying amount of the asset, and then recognize an impairment loss for any excess over the estimated recoverable amount or net realizable value in accordance with the requirements of IAS 36 or IAS 2 as appropriate. Disclosure. Entities are required to disclose: 1, the amount of borrowing costs capitalized during the period, and 2, the capitalization rate used to determine the amount of borrowing costs eligible for capitalization.
Yeah, the disclosure is very straightforward. And I'll take you back to the issue of when the carrying amount exceeds the recoverable amount. Remember, the issue that borders on writing down the value of an asset, what is recoverable, which is in tandem with the requirement of IAS 36, will equally apply in this case. And if it's for PPE, investment property carried at cost, or for intangible asset. But again, intangible asset barely, or in some instances, barely qualify for borrowing costs to some extent. Okay, and if it's for inventory, it goes by way of write-off, because IAS 36 does not apply to inventory. Now, what also matters extensively is the commencement of capitalization. You only commence the capitalization of a borrowing cost under certain conditions. 3 conditions must exist. The conditions are as follows. 1, expenditure must have been incurred on that asset. 2, the borrowing cost must also have been incurred, which means you have borrowed to fund and you are incurring costs relating to that borrowing, which is specific to that borrowing. And 3rd, activities are in progress that are necessary to prepare the assets for intended use, which means construction is going on, production is going on, manufacturing is going on. But that doesn't mean that there might not be intermittent delays, stoppage, and all sorts of things. But once it is temporary, capitalization of borrowing costs will still continue, because those delays are expected delays within such an activity. But again, the standard makes us understand that you suspend borrowing costs. What it means is that instead of you capitalizing the borrowing cost, you will now start to expense the borrowing cost once there's an interruption, active development that have brought about interruption for an extended period, which means interruption that says, okay, like for example, we are building something and government have to come and stop it, and the case is in court. It's not 1 month, it's not 6 months, it's 1 year and co. It then means that you will still be paying the bank you borrowed money from. Such interest is not integral part of the construction, because this kind of issue you have with government is not issue that is integral part of that construction. It's an issue that arose from some some inefficiency or some failures, or whether from the part of government or from your own part or from both, that has extended arbitrarily such period of delays. At that point, such will be suspended for capitalization. And once it's suspended for capitalization, it will be expensed. The second factor is when the borrowing cost ceased. It ceased at the point the asset is now ready or available for its intended use, which I've explained earlier. But where it is dicey is that if the nature of the asset is such that it has various parts that might be deemed to have been completed for its intended use, you still you cease to capitalize for those particular parts that have been completed. While for those other parts that is material are not completed, you still continue to capitalize to their own aspects, which means your borrowing costs will now have to be allocated based on various contributions of those parts or stages to be able to determine what portion belongs to each part or stage that will qualify for capitalization and the one that will no longer qualify for capitalization. As we have told you, it is not necessarily that everything must have been completed, but by nature, it has gotten to a state where it is available for their use. Suspension, again, of borrowing costs will not necessarily be required if it is a temporary delay, which are administrative in nature, which are technical in nature, which are considered integral parts of the whole process. Okay, another thing I want us to look at is issue of impact of tax on borrowing costs. Can you read that out for us?
Impact of tax on capitalized borrowing costs. Although IAS 23 does not specifically mention tax, it is clear from the way the borrowing costs are defined that the amount to be capitalized is not affected by whether tax relief will be obtained in respect of borrowing costs. That is, borrowing costs will be capitalized on a gross basis and not net of any relevant tax relief. In some jurisdictions, tax relief may be received on borrowing costs when they are incurred, irrespective of whether those costs are capitalized. When this is the case, a temporary difference will arise and the entity should apply the requirement of IAS 12.
Okay, yeah, that's that, which means IAS 12 applies necessarily, which means borrowing costs you are talking about is excluding the effect of tax whatsoever, okay? And that is that. Okay, we've discussed every other aspect, and that brings us to the end of our discussion. Any other question, contribution, deliberation, or otherwise?
I just have one question in the aspect of when capitalization of borrowing costs ceases as a result of a prolonged delay in the projects. So if we start charging the interest payment to P&L, and maybe after 1 year or after 6 months, we return back to the projects. So the amount that had already been charged to P&L that relates to the project we are talking about, will it be reversed and later capitalized?
No, it doesn't relate to the project because it's not within the period of projects. Do you can say now? The period of 1 year, 2 years you are in court with government has nothing to do with the requirement of the project. Do you can say now? It's not contributing because the project is for 2 years. You've just completed 1 year before it was suspended because of court case, or Monile case, government case, and all sorts of things. It has nothing to do with the construction to which you are borrowed for. You can say now.
Okay.
If the delay has been temporarily, like government is telling you that your permit have issue, or you suspend it, get the permit, and it's 1 month, 2 months. It is temporary. We'll say, okay, it's an integral part of it. but it has gone for an extended period, such will not be considered an integral part of the project because such will never have been factored into the project. Are you getting it, sir?
Yeah.
Okay. Any other question?
So another thing is that in the question we solved, the last question, it was not specifically mentioned that the first two borrowings were general borrowings. You understand? I don't know, maybe the only why you concluded that they are general borrowing is because of the word using existing borrowings. Was that the reason?
That is one factor. That is one factor too. The second factor is that, okay, if it's not general borrowing, what information do you have that specify where they borrowed from and at what rate to fund that project? Are you getting it, sir?
Yes. Because
if you go to a particular bank or a source to fund for a particular project different from others, you will provide that information. If you don't provide that information, that means that you are borrowed from the pool in which the company has sourced from. And that's why you saw me coming back here to give you another scenario whereby, apart from going to the pool, you only go to the pool for the remainder after sourcing for 12 million specifically for that project. Does that make sense, sir?
Yes, it does.
Okay. In the absence of none, I think we'll call it a day for our discussion with respect to borrowing costs. Thank you very much, and God bless you.
God bless you too.